Hello there, healthcare employees, and welcome. Thank you so much for joining us today. We truly appreciate your time. I'm Sam, and I'll be behind the scenes throughout this presentation, monitoring any questions you may have. You will find a anonymous Q&A box here on the screen. Feel free to ask away. I will make sure one of our healthcare-focused financial advisors can reach out to you after the presentation to answer any questions you may have had. Today we're going to be hearing from Kevin Wan. Kevin Wan is going to be giving a very insightful presentation on some really great strategies you can use to boost your pension plan from your healthcare company. But before he comes on, just a couple other quick housekeeping items for you. First and foremost, please be reminded that we are not your healthcare company here. We are not affiliated nor endorsed by your healthcare company. We are a completely independent group of financial advisors here, so please keep that in mind as you're listening along with Kevin today. Next, you can use the links that will be popping up above our heads there. Those are clickable links. You can click directly on those. They will guide you to our calendar where you can book a complimentary 15-minute block of time with one of our financial advisors to speak to them directly about your situation or to get started or updated on your retirement planning. We'd be thrilled to help you with that. And lastly, please consider following us over on YouTube as well as over on LinkedIn. We post tons of healthcare employee related content each week, and we really think you'd get some value out of it if you considered giving us that follow. And if you do, thank you so much in advance. We truly appreciate it. And with all of that out of the way, we're going to jump right into it now with Kevin Wan.
I'd like to welcome everyone to today's Kaiser Pension webinar. My name is Kevin Wan, Financial Advisor, and I'm part of the KP Pension Planning Team at Wealth Enhancement Group. Just a little bit of background information about myself. I have more than 15 years in the business and financial planning space. Prior to becoming a financial planner, I did serve in the U.S. military for more than 7 years. Was actually in Special Forces and the Green Berets, jumping out of airplanes, doing wild things like that. But I've been able to take that military discipline into the financial planning field, especially when it requires a disciplined approach for Kaiser employees and other clients that we help in building their wealth. We specialize in the Kaiser pension plan and the benefits and how that all ties together into your ultimate retirement and financial plan. Now, a little bit of background information about Wealth Enhancement Group. This is our parent company and how we're perfectly suited to be able to help and address your retirement and financial planning needs. We have 146 offices nationwide, including 7 offices in the Northern California region. We have 2 offices in Oakland, 1 in Walnut Creek, El Sobrante, in addition to offices in South San Francisco, Novato, and then Larkspur. So if there's ever a need to meet one-on-one with someone on the Kaiser Permanente retirement team, we could certainly do that. Having said that, post-COVID, a lot of our meetings now are occurring virtually over a screen share. It could be a Zoom meet, a Teams meet, or a Google meet. So we could certainly do that if you'd like to meet virtually as well. We have 6 key service areas that we focus in on that you could see: investment management and financial planning, pretty much standard amongst all financial advisory firms. But on top of that, we do have strategies and tips and even CPAs and lawyers on our team to be able to offer tax strategies in addition to estate planning strategies. And with taxes, being in the state of California, Uncle Sam could receive 50% of your W-2 earnings just going to taxes alone. So our goal at Wealth Enhancement Group is to make sure we can keep your tax bill as low as possible, not only currently, but during your retirement years as well. And then estate planning, that certainly comes into play just about everyone here in attendance today, because if you don't decide what to do with your estate, you know the government's going to decide for you. So nobody should be in that situation, especially with our company where we could provide those services to you. Now, we also offer weekly and monthly educational webinars. You could see some of the topics that we cover. It could be Social Security, something about the pension, perhaps, a topic could be, should you take the lump sum versus the monthly pension? Regarding Social Security, when should you start that? Should you start it at 62, wait until full retirement age, or should you wait until 70? If you're married, should you do a staggered start regarding Social Security? Regarding the 401k, we cover topics like that. What is an appropriate asset allocation based on your risk profile? So a lot of different webinar topics that we have. And there's a saying, knowledge is strength, and especially in the financial planning and retirement space, you want to be as knowledgeable as you can. And at the same time, you have Wealth Enhancement Group and our team of advisors to help you review and analyze your retirement and financial planning situation. Now, one of the biggest mistakes that we see that Kaiser employees make, in addition to other clients and prospects that we work with, is picking the wrong date to retire. Now, the normal retirement age usually is going to be 65, especially at Kaiser. That's the normal retirement age, in addition to a lot of Fortune 500 companies. But do you have to wait until 65? It's not a one size fits all. It varies from person to person. But picking the optimal retirement date is critical. And some people actually choose the date just based on what their colleagues are telling them. So we'll actually cover some tips and strategies on different factors to consider when picking that retirement date so that you could walk away with the largest pool of capital whenever you decide to retire. Now, when you ask yourself what sources of retirement income will you have in retirement, you could see there's many different sources. If you could visualize a stool, a retirement stool, or like a chair with various legs on that stool or the chair, potentially one of the legs could be some retirement income or job earnings, right? You could have a part-time job to stay busy during retirement. Maybe you have a side business or a side hustle that you plan to pursue during retirement. So that could be a source of retirement income during your retirement years. Other sources are going to be Social Security. We just talked about that. That's going to be a critical component to your retirement income. There could be savings and investments. It could be an outside brokerage account. It could be even your retirement accounts. It could be like a 401k, 403, 457. It could be a traditional IRA, Roth IRA. That falls under that savings and investments bucket. And then the fourth item that you see is the pension. Now, not all retirees have pensions. So at Kaiser, you're fortunate enough to have this terrific and wonderful benefit, which is the pension, which is what we'll cover today. Now, the agenda that we'll cover is going to be the key pension terms that are common amongst all the pensions at Kaiser. But one thing to keep in mind is that Kaiser operates in 9 different states. And from state to state, although there's going to be plenty of similarities regarding these pensions that we discussed today, there's going to be some slight differences amongst the states. And even a state like California, there's the Northern California region, Central region, and Southern California region. Again, there's going to be a lot of similarities, but even amongst the regions within a state, there's going to be some slight differences. So just keep that in mind. The 3 Northern California pensions we'll discuss today is going to be the Kaiser Permanente Salaried Retirement Plan for KPHP and the Kaiser Foundation Hospital employees. And then we'll talk about the TPMG pension plan for physicians. And then we'll talk about the Kaiser Permanente Employee Pension Plan for the nurses. And then we'll wrap up the discussion with the pension distribution options that are available once you decide to turn on that pension income stream. Now, some of the key pension terms with all the formulas in the defined benefit pension calculation, it's always going to start with a final average monthly compensation. Other terms that are used are highest average compensation, but basically it's going to take a look at your work history and carve out a certain portion of the highest earnings during that period, and it's going to use that in the formula. Credited years of service will come into play in addition to pension offsets. And as I mentioned earlier, normal retirement age at Kaiser is 65. It doesn't mean you have to wait to 65. You could retire sooner than that. But the sooner you retire, the earlier you retire, the greater the pension offset will be, or the deduction from that monthly pension amount. And then vesting for the defined benefit pensions at Kaiser, it's going to be 5 years of vesting. But some of you may also have pension plan 2 in your overall pension plan, which will have a different vesting schedule, which we'll talk about in just a few minutes here. Okay, now the first pension we'll talk about is the Kaiser pension for salaried retirement plan. It's for the KPHP and the KFHA employee. So it's going to take a look at your last 10 years of work history. And then within those 10 years, it's going to take the highest 5 consecutive years, or the highest 60 months of consecutive compensation. That's at the highest level. And then it's going to multiply it by what's called a benefit multiplier, which is 1.5% under this pension plan. So it's going to take your final average monthly compensation times 1.5%, and then it's going to multiply it again by your credited years of service, and that'll produce the monthly pension. Now, the monthly pension in these formulas, what that represents is someone that retires at age 65, the normal retirement age, and this monthly pension represents the single life annuity option. And all the other pension distribution options are derived off of this monthly pension amount that you see. Okay, now from the monthly pension, if there's any pension offsets or age penalties, that would be deducted from that monthly pension amount. So let's take a look at what that looks like. Again, normal retirement age is 65. If you retire from 64 to age 55, there's going to be a pension offset or an age penalty. So on the screen, you can see at age 64 all the way down to age 60, there's a 3% annualized penalty. And then from age 59 to age 55, there's a 5% annualized penalty. So just keep that in mind. If you do decide to retire, there's going to be some age penalties or this pension offset that comes into play. Now, graphically, you can see the bar chart. Age 65, you would receive 100% of your monthly pension, but that you could see each year that you retire prior to that normal retirement age, it's going to decrease in value. Now, the next pension we'll talk about is for the Permanente Medical Group, the TPMG physician pension plan. And today we'll talk about the Pension Plan 1, Pension Plan 2, and the Pension Plan 3 for the physicians. Now, the TPMG Pension Plan 1, what it's going to do, it's going to take a look at your entire work history at TPMG, and then it's going to carve out the highest consecutive 36 months of compensation, and that is what's called the highest average compensation. And then it's going to use a benefit multiplier of either 2% or 1%. So the first 20 years of service, it's going to use a 2% benefit multiplier, and then for years of service 21 and beyond, it's going to use a 1% benefit multiplier in the calculation. And once the math is computed, it'll actually produce that TPMG monthly pension for the physician. Now, let's take a look at an example here. We have a physician that's 65 years or older retiring. So that means he or she is going to receive 100% of their monthly pension without any age penalties or pension offsets. This physician worked 30 years or has 30 years of credited service with TPMG, and the highest average compensation for this physician was $20,000 per month. Now, the benefit multiplier, what it's going to do, the first 20 of those 30 years of service, it's going to multiply those 20 years by 2%, which is 40%. And then years 21 to 30, those 10 additional years of credited service are going to be multiplied by 1%. So the 40% plus the 10%, that equals 50%, and then 50% of the $20,000 highest average compensation of $20,000 would be $10,000 as the monthly pension for this physician in this example. Now, the Pension Plan 2 for the TPMG physicians, this is called the Contribution Pension Plan. TPMG is going to take a look at your monthly base salary plus any bonuses that you may have received during the month, and they're going to multiply that by 5%. And that amount is going to be added to your Plan 2 pension. Now, Also, that something that comes into play with this pension plan too is the Social Security wage base. And once you hit the Social Security wage base, there's a couple of good things that happen. Number one is that 6.2% payroll tax goes away, and that's why you actually see your paycheck increase once you reach that cap. And then with the pension plan too, what TPMG will do, once you hit the 176,100, which is the cap, Social Security wage-based cap for the calendar year 2025. Now what they're going to do is take 10% of your base salary plus any bonuses received, and then they're going to add that to your pension plan 2 balance. Okay, that is the pension plan 2, how that works. Now regarding the vesting, you can see after 1 year of service, you're going to be vested in this plan 2 pension, although it's only going to be at 10%. After 2 years of service, or 2 credited years of service, you're going to be 30% vested. After year 3, you'll be 50% vested. After year 4, you'll be 70% vested. And then after 5 years of service, you will be 100% vested in the Plan 2 pension. Now, the Plan 3 pension for TPMG physicians, this is just simply called the 401k salary deferral plan. So for calendar year 2025, if you're younger than 50, you can contribute $23,500 into the before tax bucket of the 401k. Now, if you're 50 and above, there's a thing called a catch-up provision. That catch-up provision is $7,500 for anyone 50 or older. So if you add those two numbers together, 23,500 plus 7,500, that equals $31,000 that could be deferred into the 401k salary deferral plan. And that'll actually lower your taxable income by $31,000 for the current year. And then you would only be taxed once you actually start taking those distributions from that 401k. Now, there's been a new tax law that came into effect January 1st, 2025. Anyone that is age 60, 61, 62, or 63 during calendar year 2025, their catch-up provision has actually increased. Instead of it being 7,500, for those people 60 to 63 in calendar year 2025, their catch-up provision increases to 11,250. So 11,250 plus the 23,500 for anyone between 60 and 63 in calendar year 2025 would be able to defer $34,750 into their before tax bucket within that 401k. So it's a great retirement savings vehicle that we encourage everyone to participate in. Now, the next pension we'll talk about is the Kaiser Permanente Employee Pension Plan, and this pertains to the nurses at Kaiser. Now, it's going to take a look at your last 10 years of work history, and then it's going to carve out the highest 5 or the highest 60 months of average consecutive compensation. It's going to multiply it by 1.45%, but notice here that this benefit multiplier is slightly different than the two previous pensions that we just looked at. So it's going to take your highest average compensation times 1.45% times the total credited years of service, and that'll produce the monthly pension. Now, with the pension offsets for the Kaiser Permanente Employee Pension Plan, you notice at age 64, it starts off at 5%, and it stays 5% all the way down to age 55. There's no fluctuation. It's a consistent 5% annualized penalty, again, from 64 all the way down to age 50. And the bar graph, just like the other formulas, you can see at age 65, you'll receive 100% of your monthly pension. Each year that you take or that you decide to retire, that monthly pension will decrease in value. Now, we're going to switch gears and talk about the pension distribution options, once you decide to start your pension. Now, there's a lot of different options that Kaiser has available, and keep in mind, it's not a one-size-fits-all. What may work for your colleague may not be the perfect solution or the perfect distribution option for you. Someone may be single, another retiree may be married, another retiree may be married with a previous marriage, or maybe it could be a situation where a retiree has a qualified domestic relations order that comes into play. So just keep that in mind. It's not a one-size-fits-all. We'll cover some of the key distribution options. We'll talk about some of the pros and advantages of these distribution options. But keep in mind, just keep an open mind, it's not a one-size-fits-all. And if you have any questions regarding this distribution options, be sure to reach out to myself or one of the other team members on the Kaiser team. We can actually run different scenarios for you. For example, if you wanted to take a look at the pension lump sum, we could certainly run that scenario for you and see what that looks like throughout your retirement years. Or if you decide, for example, to take the monthly pension, say the joint and survivor 100% option, we can run that scenario for you to see what that looks like as well. So the first pension distribution option we'll talk about is the single life annuity. Now keep in mind, when we took a look at those pension formulas, that monthly pension amount represents the single life annuity distribution option for someone taking it at age 65. And then all the other options that we discussed today are going to be derived off of this single life annuity amount. Okay, now with the single life annuity, just like it sounds, it's just based on a single life. It's going to be based on the retiree's life. Now, once the retiree passes, that's the end of the pension, whether this retiree lives to age 70, 85, 100, or 120. It's guaranteed to pay out for his or her lifetime. Now, one of the disadvantages or the risks involved with the single life annuity is an early death situation. So say a retiree retires, and then after the 5th year of retirement, there's an early death situation. Well, at that point, that's the end of the pension. No further payments are made. So one way to protect yourself, if you do decide to go with a single life annuity option, for example, if you are to receive $3,000 per month as a single life annuity monthly pension, what you could do is actually carve out a small portion of that $3,000 per month pension. Let's say, for example, you took $200 or $300 out of that $3,000 pension, and then you use that $200 or $300 as a monthly premium to purchase a life insurance policy, let's say with $1 million face value. So in this situation, with an early death situation, the Kaiser Permanente single life annuity pension would disappear upon death if there's an early death situation. However, the life insurance policy that was purchased with a small portion of that single life annuity would now be payable to your chosen beneficiary tax-free. So if you had a $1 million face value life insurance policy, that amount would pass on to your chosen beneficiaries again, and it would be tax-free. And if you have any questions, be sure to reach out to myself or one of the other team members. Now, the next pension distribution option we'll discuss is called the joint and survivor annuity option. And you could actually elect different percentages. It could be 50%, 66 2/3, 75%, or even 100%. So just like the name sounds, it's joint. It's going to be based on 2 different lives. The retiree's life, in addition to typically his or her spouse or significant other, known as the joint annuitant. Now, with the joint and survivor 100% option, let's say, for example, the monthly pension starts off at $2,800. If one of the 2 spouses passes, that joint and survivor monthly pension would remain at that 100% level for the rest of their life. Now, with the joint and survivor 50% option, what would happen there is if one of the 2 spouses were to pass, let's say the pension started off at $2,800. With the joint and survivor annuity option, it would drop to that 50% level or to $1,400. So that $1,400 joint and survivor 50% option would now be paid out to the surviving spouse for the rest of his or her life. And of course, you could elect 66 2/3 or 75% as well with this joint and survivor annuity option. Now, this next pension plan option we're talking about here, this is called the joint and survivor 100%. We pretty much covered that just a few seconds ago. But this option here has 2 add-on features: 15-year period certain, and then with an add-on feature of the pop-up provision. So it's a pretty wordy title, but we'll break it down for you. So the 15-year period certain, all that means is that this pension is guaranteed to pay out a minimum of 15 years. And of course, if you live longer than that 15-year period, it will continue to pay, but it's guaranteed to pay out 15 years. So what happens in an early death situation between the retiree and the joint annuitant? Let's say they both pass after year 5. There would still be 10 years remaining to get to that 15-year period. So those 10 years would be paid out to your chosen beneficiary at that point if there was an early death situation for both parties after year 5. So it just simply means it's guaranteed to pay out a minimum of 15 years. Now, with the pop-up provision, what happens here, if the joint annuitant passes before the retiree, what happens is that joint and survivor monthly pension would actually pop up to the higher level, which represents the single life annuity amount. So again, if the joint annuitant passes before the retiree, the monthly pension with this pop-up provision will pop up to that higher single life annuity amount, which could mean several hundreds of dollars in additional pension, monthly pension that would be paid to the retiree with this pop-up provision. Now, with the fixed period and life annuity option, it's similar to the 15-year period certain that we talked about, except that there's different periods that you could choose with this option. You could choose 5, 10, 15, and even a 20-year period certain. And all that means is that it's guaranteed to pay out that chosen period. And of course, if you live longer than that, it will continue to pay out until death. And that's the fixed period and life annuity. Now, the lump sum option, this is one of the most popular choices amongst KP retirees. And the reason why is they can get their hands on this pool of capital all at once when they retire. And of course, you'll want to do the direct rollover into an individual retirement account. The custodians we use at Wealth Enhancement Group is Fidelity and Charles Schwab. So we would just simply set up your individual rollover retirement account, and you would take the lump sum and you could actually do a direct rollover into that newly established IRA rollover account. And as long as you do the direct rollover with the lump sum, there's no current taxes at that time. It only becomes taxable once you start taking out those distributions from that lump sum that was rolled over into that rollover individual retirement account. Now let's talk about how this lump sum is calculated. Now keep in mind, when we looked at those formulas, it produced the monthly pension for the single life annuity. So what the lump sum formula does is they take that monthly pension for the single life annuity and then they extrapolate that into the future based on mortality tables and actuarial tables. So once that amount is arrived at, they discount that future amount back to the present value. And when they do that discounting back to the present value, it uses what's called the IRS segment rate. So you can see first segment, second segment, and third segment. These interest rates are published by the Internal Revenue Service on a monthly basis. And the first segment, second segment, and third segment, it represents the short-term, intermediate term, and the long-term corporate bond rates. Now, the first segment interest rate is used for the first 5 years in that pension lump sum formula. And then the second segment is used for the next 15 years of retirement in the pension formula. And then the third segment interest rate is used for retirement years 21 and beyond in the pension lump sum formula. Now, with the interest rates, there's an inverse relationship. When the interest rates go up, the pension lump sum will actually decrease in value, and the opposite is also true. When interest rates go down, the pension lump sum increases in value. And if you think back to the 2021 period, interest rates actually dropped 3%. Now, when interest rates drop by 1%, it's going to increase that pension lump sum approximately 10 to 12%. So that means when that interest rate dropped 3% during COVID, the pension lump sum increased in value approximately 30%. So that's why you saw a lot of your KP colleagues take the lump sum and walk away during that COVID period. And the reason why is because they walked away with a pension lump sum that was approximately 30% higher in value. Now, based on this information, our company, Wealth Enhancement Group, we keep a close eye on the trend of these interest rates, because when Kaiser calculates this pension lump sum, they use what is called a 2-month look back on the interest rate. So, for example, if someone had a May benefit commencement date when they wanted to start their pension, the formula is going to look back 2 months on the interest rate. So from May, you go back 1 month, that would be April, and then the second month look back would be March. So that's why on the top row, you could see those interest rates 4.5, 5.33, and 5.86. Those IRS segment rates represent the March rates, and that's what that 2-month look back represents. It's a 2-month look back from anyone using that that May 2025 benefit commencement date. Okay, so knowing about this and having this knowledge regarding the trend of these interest rates, you could actually pick an optimal time when to retire. And the reason why is so that you could walk away, hopefully when the interest rates are lower or have decreased in value. By doing so, you'll be able to walk away with a larger lump sum. Okay, now this last pension distribution option we'll talk about is the installment payment plan, and this is for the TPMG pension plan for the physicians. Now, unfortunately for the physicians, for some reason they don't offer the lump sum. So we often get the question, hey Kevin, what is the next best option? The next best option is going to be this installment payment plan. So you could actually choose an installment period, let's say for example 5, 10, 15, 20, 25, even 30 years. You could actually pick that installment period. And let's say, for example, if you chose the 5-year installment payment plan, year 1, year 2, year 3, year 4, year 5, you would receive those installment payments over that 5-year period. And once you reach that 5-year period, essentially at that point, you would have received the entire lump sum. So that would be the best option for the Kaiser physicians that want to get their hands on the pool of capital as quickly as possible. Now, as we wrap things up, there's an interesting statistic. 74% of Americans age 50 and above do not have a written retirement plan in place. And really, there's no reason to not have a written plan, especially with a company like Wealth Enhancement Group, where we offer Kaiser employees a complimentary cash flow analysis. And all it is really just gathering all the scattered pieces of that retirement puzzle together, and we apply different assumptions to those numbers, inflation factors, and then a very conservative rate of return. And then we take a look at your expenses. Those expenses would receive an inflation factor, and then we extrapolate those numbers into the future, year by year, throughout your retirement years, all the way to life expectancy, even to age 100. But one of the goals, or one of the benefits of having this retirement blueprint or retirement roadmap, whatever you want to call it, is to make sure you have a rock solid retirement plan in place. Because once we run the numbers, if there's any red flags or shortfalls, it'll become apparent immediately. And nobody wants to be 75 years old in retirement, running out of money, and then having to go back to the workforce to make ends meet. Now, on the other side of the spectrum, if you end up with a big surplus at, say, life expectancy or even age 100, certainly tax strategies and estate planning is going to come into place. Again, there's no reason not to have this written retirement plan in place. Now, why should you go with the Retirement Group and Wealth Enhancement Group? We have a Kaiser team with more than 150 years of combined experience helping healthcare professionals and Kaiser Permanente employees like yourself. We offer that complimentary retirement cash flow analysis, whether you're active or retired. And even if you decide not to do business with us, all we ask is that you refer some of your colleagues to us. And essentially, that's how we've grown the business over the last 3 decades. And again, we have offices nationwide, 7 locally here in the Northern California region. If there's ever a need to meet face-to-face, we could certainly do that. Or if you'd like to meet virtually, we could certainly accommodate you as well. Okay, so that is the end of the formal presentation. If any of you have questions, be sure to put that into the chat, and we'll try to get to as many questions as possible. And for those of you that have to go, I'd like to thank you for attending today's webinar. We look forward to seeing you in the near future. Take care. Bye-bye.